Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I will be your host. Today, I am joined with my good friend, Doug Heagren. Hey, Doug.
Hey, Kirk. How you doing today? Happy Friday to you, and hope everything's going well for everybody out there listening today.
Yeah. Well, let's dive right in. We got lots to talk about today, Doug. We just got the GDP number out, which is interesting, and we also have some new news on the real estate front. So let's dive right in. We had oddly enough, I think it was last week, we saw a bunch of news reports come out about real estate funds freezing withdrawals. And these aren't just any real estate funds. These are KKR, Blackstone, we've got Starwood, and I think those are the big three that we found. So what are your thoughts on this, Doug? I'm going to pull these up and see if we can share.
Well, to me, it's two sides, right? It's number one, we've got issues in real estate. I mean, real estate is very sensitive to interest rate numbers. But a lot of times the real estate that we're talking about here is commercial real estate, which is not only tied to real estate numbers, or I'm sorry, to interest rate numbers like residential, but it's also tied to supply and demand issues. And if you take a look at what has gone on both fronts since COVID, we've had a lot of places that have decided to not use commercial real estate the way it was pre-2020, right? A lot of people are working out of their homes. A lot of companies, at least at the time, said we're not going to go back to to the level of real estate and usage that we had previously. So there's been a lot of pressure on triple net commercial types of real estate investments, but there's also the pressure on the residential real estate investments because obviously we're having a significant decline in the valuation of, or not really necessarily the valuation per se. That's a secondary effect of the stall in the transactions that are going on in real estate right now because of the cost to acquire. Since money's not cheap, that's obviously creating issues on both fronts. But it also brings me to a second thought, and this is an investor behavior standpoint, Kirk, is that why are there redemptions going on anyway? If you think about one of the fundamental problems that has been, kind of escalated over the modern day of investing is that instead of treating it like something that was a long-term focus, people are treating investments now more and more like something that is short-term return, treat me better. I mean, we see this with companies all the time. Their boards of directors are absolutely pressured to make short-term decisions for the benefit of a quick gain in the markets. If you think about how often people turn over, we've seen a declining hold period of investments. Well, what is probably one of the most illiquid assets out there? I saw somebody post on Twitter today, said, if I didn't hold real estate, I would probably be churning my portfolio all the time. It has kept me more disciplined because the illiquidity of real estate is a positive thing. He saw that as, and I could argue that. I mean, if you're going to go into private equity, if you're going to go into real estate, how many people buy a home and have really truly thought about buying home in real estate thinking, I'm going to buy this for a couple months and get out of it? I mean, yeah, we had our flip period that, 15 years ago, some people still flip, but the reality is it's an illiquid asset. It's hard to acquire. It's expensive to hold. It's expensive to distribute. So why are people getting into these investments and expecting to get liquidity back out? They wouldn't think of that if they were actually holding the brick and mortar themselves. And that brings back to not just the issue of patience and investor behavior and psychology, but it also comes back to the issue I've talked about time and time again. If you are asking for liquidations or redemptions, number one, is it because you're impatient? If it is, think about why you're investing in the first place and how to invest more discipline. But the second piece is if you're doing it because you have to get money, well, then you went around your entire investing philosophy wrong in the first place. The number one cause of financial stress, Kirk, is access to capital. And if you got your money in these things and all of a sudden you've got an access to capital problem and you're begging for them to give your money back, none of these investments were designed to give or guarantee liquidity. So I think there's a number of things going on here.
Yeah, and those are all great points, Doug. And I think, I want to illustrate a few more is, look, these are all really important things to understand about investing, right? You need to have liquidity. Not, most people, I mean, every real estate investor I've ever known that's a true real estate investor, not like a dabbler or somebody who's just starting, but an actual real estate investor, every single one of them, every nickel they've ever earned goes back into real estate. They don't spend on anything else. They're not in the stock market. They're not investing in gold. They're just in real estate. And they're always, penny pinching. They're saving a buck on the properties. It's just a certain mentality. And you know it when you see it. Like if you meet one, you're like, oh, that person's a real estate investor, right? It's just part of who they are. And, when for people like that, it's one thing. I think for most investors who don't live in that world, one of the challenges is you don't realize that this real estate's locked up. So we've been, beating the drum on this show for the last year about inflation and the problems it's going to cause, not only, last year and this year, but for the next 10 plus years. Is the problems are going to be immense. And one of those problems is we were accustomed to 40 years of low interest rates, dropping in low interest rates, which allowed asset prices to go through the moon. And now people are realizing like, oh, I can't necessarily, real estate maybe is not going to go up anymore. So, these funds are invested by like wealthy people. This is not Joe and Susie Lunchbox who put in $10. These are like private investments with, most likely accredited investors, very wealthy investors who are putting money in there, and they're seeing the writing on the wall. Like we've been talking about it for a year. I'm sure some of them have been listening to the show, but they're seeing the writing on the wall and they're saying, I don't like where this is going. Interest rates are high, real estate's still high. Let me get out before this gets repriced. So some of this actually comes down to the fact that, depending on the REIT, of course, but most REITs are valued once a year. So it's like, hey, our assets are worth $1 billion. And then next year, at the end of January, they're going to do another valuation, say, all right, now it's worth 1.1 or, $0.9 billion. The point is it's valued once a year. So if you know that this portfolio is valued at $1 billion and you know that the property values have probably gone down 10 or 20%, you might want to get out today instead of waiting until after it's valued when you have 10% or 20% less. So one of the challenges, and this happens a lot, and this is actually, this doesn't mean that the sky is falling. What it means is it's another sign that the sky is just barely hanging on. It's not necessarily falling today, but we saw this happen in 2007, 2008. All these times where you have these contagion effects, which I talk about in the show a lot. Contagion is when one thing falls, other things fall by relation, right? So if, for instance, all these firms, KKR, Blackstone, and Starwood, they've just basically locked up the investors' money, which frankly, you should have known that going in. But they locked it up. A lot of these funds, they give you the liquidity option. They say, okay, you can liquidate it on a quarterly basis, given the availability of liquidity. So they give it because sometimes there's emergencies, so they give you something. But they always have the option to freeze it and say, all right, we're done. Because if you think about it, they have $1 billion and let's say they've got, I don't know, 100 million in cash, hypothetically. And then, 105 million in cash redemptions come in. They can't give you that all. So they want to keep some cash for the needs of the fund, but effectively they just say, sorry, we can't fulfill that. And this happened in 2008. So I want to point this out because it's an important lesson to understand where things are going. If you own illiquid investments, and you're not willing to hold on for 10, 20 years, or frankly, if you need this money, then you might want to consider taking it out. Because here's what happened in 2008. People were going headfirst into non-traded REITs in 2006, 7, early 2008. And because a lot of these things are saying, hey, we can get you 7% yields, we can get 10% or whatever it was. And hey, it's real estate. It always goes up, so you're going to make money. This was the line that people were fed. And what happened? Well, 2008, real estate prices crashed. And what happened was a lot of these funds were forced to revalue their funds. So they started at $100 a share, and then they got revalued. Some of these things got revalued for 10 and 20 cents in the dollar, which means you lost 80 to 90% of your money. And people were screaming. They're like, I want out, and they couldn't get out. And lo and behold, people, people like myself I got there a little late, but some people were out there saying, "Hey, I'll give you 10 cents on the dollar. Looks like a good asset." They were smart because they had the cash, right? They weren't all tied up in illiquid assets. They had the cash and they were saying, "Yeah, I'll buy it for 10 cents on the dollar. Sure. That's a good investment." And then it went back up and then they sold it later and they made good money on it. Or worst case, they kept it and instead of making 10% returns, they're making 40. And so the understanding of how this could play out is you could be stuck with an asset that's valued less 10 years from now, not because real estate's not a great investment, but because the market priced it lower because of other dynamics that we've talked about in the show. So the thing to understand about this is things can go down, they can stay down there. And if you need the money, you're going to be in big trouble. So what I would suggest is look through your entire portfolio, see what's illiquid, what you can and can't get out of. And personally, I would be as liquid as possible right now in the markets. Why tie your money up in something that's not going to give you a better return for the illiquidity factor? If you can buy something illiquid, you're getting 30% returns, like at a great discount, fine, tie it up. But if you're getting 5, 7, I would not take that for the illiquidity issue that's going to come in.
Yeah, so, and you made me think of a couple of things on that note. I mean, you're right. I mean, most of the time when you go into these things, most of these types of investments have kind of a mandate on that, or not a mandate, but an expectation that they put out that you should really think 7 to 10 year hold on, at a minimum. Now you talked about 10 to 20, and I agree, but a minimum, most of these will tell you is that we have an attempt, that is our goal, to have a liquidation event of some kind within 7 to 10 years. And so anything less than that, you certainly shouldn't expect to get your money back. Now, some of them, as you mentioned, will kindly say that we will give some redemptions when available earlier than that. But that is not supposed to be the norm. That's the exception. And they have the right to clamp that down because, again, they're investing their money that you're giving them in illiquid brick and mortar. And that makes it very, very hard to get that money out. So 7 to 10 years. Now, the way these things work, which can be very beneficial, is that you might get 5, 6, 7% income yield on these over that period of time. So in theory, I mean, Kirk, if you were to wait 10 and it dropped from $100 down, by 50% down to $5, right? Well, I mean, if you lost 50% there, but you were able to get 7%, which actually would be a higher yield on your value once it drops. I mean, in theory, the income off of it could potentially pay you enough to overcome that volatility by the end if you're patient. Now, there are certainly exceptions to those rules after 2008 where they had to stop income distributions too because they just didn't have the funds. And those were, again, products of investing at the wrong time in the wrong things, markets turning. 2008, it was a totally, credit crisis back then. We have some other fundamental issues now that are going on that, of course, nobody foresaw COVID changing triple net commercial properties into a place where, they're at 40% occupancy. Nationwide Financial went to all of the, most of the properties that it had around the country and said, we're never going back. All of those landlords, which again, a lot of those buildings are owned by some sort of private equity and REIT, all of them had expectations of having a company like Nationwide be a tenant for the next 10 to 20 years minimum. And all of a sudden, boom, COVID comes along and they lose 30% of their occupancy overnight and they're never getting it back. So some of those things are out of control, but that's the volatility that happens here and why real estate isn't just this wonderful, perfect return environment that some people claim it to be. I've known people in real estate, like you said, it's what they do, but many of them have accepted multiple bankruptcies along the way. They make millions in the boom market, and then all of a sudden liquidity causes them to have nothing and go bankrupt in the down market. It does have its risks. Now you add on top of that, and I think this is really important for the average listener to listen to. This is why investing has these what they call accredited investors, right? So some of these products, they say they will not let you get into them if you don't have, $250,000, of income or $1 million in assets, because they're thinking you're going to have some sort of flexibility and liquidity to be able to weather these levels of risk. But I'm seeing it right now. You're talking about people that do not like to see their principal be reduced. Most multimillionaires, the wealthy, guess what they don't want? They don't want to touch their principal. They love the income. And they try to put it in places where that income is going to be consistent so they don't have to try to touch the principal. Right now, they're fearing that they're going to lose their principal. These are the wealthy. These are the credit. I will, and if we put these in camps, these are the smart money. Then you go back to what they call the FOMO, the MOMO, the dumb money. The average of retail investors chasing returns. And you're still seeing it out there. Well, I'm buying real estate. That's the only place I'm going to put your money. I'm not saying don't put your money in real estate, but I am saying if we're watching these supposedly sophisticated investors that everybody down here wants to become, and they're saying that I want to get my money out of it, it's a sign that you should be listening to. Okay. Like you're saying, Kirk. I also think that you have to also consider the fact that, once again, a lot of people, unfortunately, if I were to look at their average investment, they've got a ton of money sitting in their 401k, and then they've got real estate. Most people don't have true asset diversification to create the liquidity. You just talked about these guys that came in and bought these deals at 10, 20 cents on the dollar. Wouldn't we all love to have that opportunity? Have you ever heard the saying, buy low, sell high, Kirk? I don't know.
Maybe once or twice.
Maybe once or twice. Most people do not have the opportunity to take advantage of buying low and selling high because they don't have access to capital. When those opportunities come along, it'd be nice to buy things at 20 cents on the dollar and stock up, but they already had everything invested in the first place, and it's illiquid, and they can't get it out of their 401k, and they can't get it out of their real estate, and they can't get it out of whatever else they have their money put into. Maybe it's even their taxable investments, but the portfolio just fell by 50%. To me, that's illiquid because, Kirk, you would tell, and so would everybody else, you don't want to sell your portfolio when it's down 50%. And even if you did, it's already down. So I'm going to take an investment, sell it down to buy another investment down. You have to think about, this is why we stress that cash or cash access like investments are always a good piece to have in your financial wealth. And people get tied up on, well, I'm not making any money on that. That's okay. Warren Buffett had no problem making nothing on $1 billion. For how long? Why? Because as he always says, it gives me options tomorrow.
Yeah. And you raise a good point, Doug. We've been beating this horse for over a year of cash, cash, cash. And we've just gotten nonstop comments about cash. It's terrible. You're going to lose your value to inflation. And I've been hearing this over and over. Ray Dalio, for God's sakes, he says cash is trash on his posts. I'm like, yeah, for a guy like that, he needs to say that because if everybody went to cash, the whole stock market would crash. So he's got a responsibility. And I guess if you're looking at cash over 100 years, he's correct. Over 100 years, cash is trash. The data will prove that history would prove that. I don't know if it proves the future, but it proves that history is what it is. But, I think the takeaway here is what is most important, right? What are you looking to get from your investments? Now, most people say, well, I just want a return. Okay, great. You want a return. Are you going to get that return? Now, we've been fortunate for the last 40 years. We've gotten great returns in the equity markets. We've had some good and bad years, but overall, we've had a good return in the equity markets. But that doesn't mean it's always good. From 2000 to 2013, it was not good for equities. For the 1970s, it was not good for equities. There are always times where it's not good for equities. And I think we're heading into one of those times right now, or it so appears. And I don't mean just because the market was down 20% last year. I mean because the fundamental dynamics that are going on in the markets are very different than they have been, and people just aren't seeing it. Now, we've had some guests we've interviewed. Some of them are coming out soon, where we talk about this recalibration of the markets. It's so important to understand. If you don't understand it, you're going to be sitting around saying, "What happened after the market crashes 50%?" Here's another question we get. Well, the market's down 20. I might as well just stay in it, right? Why would I get out now? It's down 20.
It always comes back, Kirk. It always comes back. Right?
It always comes back. In 100 years, it might come back. I mean, I don't know. I mean, look at Japan. It's been down for 30 years. The Japanese stock market has been down 30 years plus, 33 years now. It's been down. And yeah, I guess it'll come back at some point. It's coming back after 22 years. It's starting to come up again. But the point is you're basically sitting on dead money. If you had just buy and hold or taken that approach in Japan, then you would have pretty much lost money for 33 years. The point is that liquidity is important. As Doug said, you need to have some liquidity. I'm not saying you have 100% cash. That's a choice, right? That is a strategic decision if you wanted to do that. We have a lot of cash in our portfolios, and clients who are listening to this will know we have a lot of cash. And we've done that strategically. We did it last year. We've done it other years. Like, it's done for strategic purposes. It is a choice. It is not an oversight. Like, oh, we just happen to have cash, we haven't invested it. No, it is done deliberately to de-risk the markets. So the markets dropped like 20 some odd percent last year. Being in cash looks like a good thing to do. You say, well, yeah, I know, but you lost to inflation. Okay, tell me something that didn't lose to inflation. And that, whatever the answer is, unless it's nothing, then that person's a liar. Because the thing about inflation is it affects everything equally, whether it's cash or bonds or stocks or gold or real estate or cows, your mama's furniture, whatever. Like, inflation affects everything equally. So I disregard it because there's nothing you can do about it, first of all. Second of all, it's not going to affect your portfolio any differently than anything else. So why spend your time, getting your knickers in a twist over something you can't control, and it affects everything equally? So I'm not saying it's not important. It's very important. This is why we're beating the horse all year. It's very important. But the point is you can't make decisions based on inflation, because you're just going to lose. No matter what you're in, you're going to say, well, I can't be in cash because of inflation. Why? That's what Wall Street teaches you, because they want you to have your money in the markets. They want you to buy their stuff. They want you to own their stocks. That's why they say buy, buy, buy. It is not because they're looking out for your best interest. They're looking out for their own. And every advisor that is on Wall Street that's helping people, they're not all in on this. They don't all understand. They're not out. This isn't a nefarious, cabal where everybody's like, hey, let me steal from the investors. No, it's a bunch of people who've come up with a thesis to keep people invested. That's the theme that product creators in Wall Street have, is we need to keep them invested. What are we going to do? And it's been a long running theme. It's not new. The advisors only know what they're taught, and what they're taught is this same theme, which is why we think differently, because we know that this is a half truth. It does work, but it also doesn't work at the same time. It's not 100% true. If it was, you could just put your money in and make 7-10% a year and not worry about it. But that's not how the markets work. So the importance of cash, and to restate my example I've used in the past, here's an example. 2008, the markets crashed. Well, peak to trough, it was about 58 and change percent. Let's call it 50. So the markets dropped 50% approximately in that period, in the 2008 crash. And if you had, let's say the S&P 500, and it went down 50%, you put in $100, now it's worth 50. Now, if I had been sitting in cash, prior to that, I could have bought $100 worth of stock. After that, I could have bought twice as much, because now it's trading at 50. So now I can buy 2 shares instead of 1 share for every share I could have bought before. So effectively, my cash just went up 100%. Now that'll swizzle your brain a little bit, right? Because you're thinking, wait a minute, cash is the same. It doesn't change in value. Yes, but its buying power doubled. And this is where people get confused with inflation, okay? You see, well, we have a 6.5% inflation rate. We obviously have inflation. Yes, but we also have deflation at the same time. So right now we have asset price deflation, stocks, bonds, pretty much everything last year went down in asset prices. Real estate is starting to. That is deflationary. The prices are deflationary. However, our purchasing our goods and services are going up, and that's inflationary. It is not a uniform thing. You can have both at the same time, and that's what we have. So I would imagine this year we're going to see further asset price deflation in real estate. And that might even spill over, because housing is 42% of the CPI. That is going to spill over, and that is going to cause the CPI to drop. We might even have a negative CPI in the next year or two. We talk a lot about inflation's not going away, but we also talk about how inflation's going to drop. The fact that we could go to a negative CPI in the next 12 to 18 months is going to make you lose your mind. But if that happens, which is very possible for a few reasons, which we can get into, that you're going to say, well, we don't have any inflation. Yeah, we still can have inflation. It just means that real estate prices are dropping so much that they're negatively influencing the markets. And energy prices and transportation could go down, which could negatively influence the CPI, which means that we could have a negative CPI. That doesn't mean inflation is going away. It just means there's a temporary blip. Remember, we talk about the bullwhip effect, right, Doug? We talk about that a lot. The bullwhip effect is about this wave, right? This wave. You know, imagine a wave. You throw a rock in the ocean, it starts to make waves, and you know, I'm not going to get into the strength of them, but basically you get waves of different degrees. So it starts out small, and then it gets bigger, and then it gets really big, and then it starts back down again. The point is, you're going to see that. Right? You're going to see inflation go down. Everybody's going to say, hallelujah, we're saved. You know, inflation's gone away. Well, that's not necessarily true. It's probably going to come back for a lot of the reasons that we talk about. One of which is politicians are stupid and they play to our baser instincts, which is the worst thing that you could do, right? When you're in pain, the politician's like, I want to make it better, so you vote for me. And they make it better and they don't. Like rent control, how well did that work? Right? That worked really well. And you know, and so these people know the lessons of history, but they don't care because they want to get elected. They want to make their earnings next quarter. They need to do the expedient thing, not the right thing. And we have a whole society of people doing the expedient thing and not the right thing. Doing the right thing means making hard choices, like saying, sorry, you're suffering. There's nothing we can do about it. But if we do something, we'll make it worse. Temporarily, it'll make it better, but long-term, it's going to make it worse. People don't want to hear that, but that's the right thing to do. And so we just don't have leaders of that caliber anymore. But go ahead, Doug.
There's a lot of things there. I mean, this is why one of the things that I think people don't put enough stock into, no, okay, pun intended.
Pun intended.
is the difference between asset allocation, investment allocation. I mean, too many people have their 401k, they've got their taxable brokerage, they've got maybe some company stock and all that. And they're basically sitting on the exact same allocation and everything they hold. And they say, I'm diversified because I've got large cap, mid cap, small cap. I've got NASDAQ, I've got international, and I'm diversified. Well, you know, as we've talked about ad nauseum, I mean, just because if you hold the S&P 500, you probably had 50, 60, 78% allocation to tech there anyway. So you weren't that diversified. Asset allocation is different. Asset allocation is holding things completely different. Cash is an asset. It is different. It is not in your stock market. It is not going to be the same thing. If you were to hold precious metals, again, some people love them, some people don't like them, but I think they have their place because they work differently. And it's something else that at different times or under different circumstances is going to give you some stability and benefit of having a different allocation to it. If we talk about real estate, again, I think real estate's a fantastic thing to hold on to, whether or not you're actually holding the brick and mortar to itself, or if you're actually, you know, investing in some of these REIT and private equity. Again, it's going to act differently. But if you have your assets diversified in different ways, you'll have the patience, more patience, to be able to wait and take advantage of those things. But I think the key there is also to ask the allocation between liquidity and accessibility and non-liquidity and non-accessibility. Too many people, again, are chasing returns. They want to have their money all in the markets. You know, they talk about buying the dip, but then they're already invested to the point where they don't have any money to buy the dip, except with new money yet to be earned. That's dollar cost averaging. That's not buying the dip. Yes, there's an advantage to dollar cost averaging because it spreads out that volatility over time, but it has no bearing or benefit to the money that you already have invested. I mean, you were talking about how the market's different for 13 years. I'm just going to give you some comparison. Since 1997, okay, now 1997 was kind of the rolling last years of the great .com bubble. Okay. And some of the best returns that you could get. It was after Greenspan said irrational exuberance. And then, whoops, sorry, bumped my desk. After irrational exuberance, all of a sudden, what the market ended up, I don't remember what it was, doubling after he said that. So clearly nobody listened. Well, since 1997, people would look at the incredible returns that we've had in the last 25 years. Okay. Well, if you started with $50,000, and I probably should make this a little bit easier. Let's just say you started with $100,000 at that time. Well, over the course of that time period, if you had been invested in it, you would see that you would have ended up with about 231,000. And that sounds really good. It's like, hey, I had 100,000, it's 231,000. I want to compare that, because if you had just earned a 4% rate of return over that same period of time, you would have beaten the markets. 4%. Now, cash wasn't earning you 4%, but I mean, there's people that have money in real estate that was earning a 4% yield. There's people that, again, for everybody, again, there's nothing more polarizing than talking about insurance, but there's plenty of people that have whole life insurance. And if you do the math on that, it's probably 3 to 4% a year. Guess what? That whole life that people are like, oh, it's trashy. It doesn't make me any money. The returns are terrible. Why would I put money there? Well, guess what? 4% compounding over that same period of time. Yeah, you're not going to be real happy that 4% in year 17 when the market made you 21. But the volatility that you had in all the other years ended up that if that just consistent, simple, boring 4% return, and your final amount of money on that 100,000 would be worth 236. Oh, and by the way, if you had another investment that you needed to go after, because I actually have a client that I'm working with right now. Now, I had nothing to do with this, but they have about $350,000 in whole life, Kirk. But guess what? They've got about $100,000 of that they actually have a loan against. And I said, well, what's this for? They said, well, that's where we took the money out of that and we invested in 3 different companies. Each one of those companies had about a $30,000 to $50,000 investment that they needed to make. They're going to take that money, and then one of them's in ethanol. One of that money is in something, I forget what the other 2 businesses are in. But I mean, yeah, they made $100,000 investment of money they pulled out of their insurance policy that was making a boring 3 to 4%. And they took that money as an opportunity to invest in something at 100,000 that's now worth almost $1 million between those 3 companies. What's that called? Access to capital. I cannot tell you the stories where getting money and having the ability to be flexible are critical. And that means having your money in different things. Some are going to be less flexible. Some are going to be more flexible. But ultimately, you want to be able to move. There's a story of a family that I was working with whose grandfather had an opportunity to invest in a restaurant. His friend came to him and said, do you have some money? He goes, I don't have any money. Well, unfortunately, his friend went ahead. He couldn't participate in it. This gentleman, his friend now owns, I think, 40 franchises of McDonald's in the Atlanta area. It's done pretty well. And this family looks back, man, if only my father had $50,000 to take advantage of that opportunity. That's what cash does. That's what liquidity does. And so when you're thinking of your planning, these things matter.
Yeah, it's a great point, Doug. And I don't think, because of the perspective that we all have, most people have not been in the market for the last 10, 13 years, right? They don't remember, or whatever, it's 14, 15 years now. They don't remember 2008. They don't remember the early 2000s. The amount of great deals that were available. If you think back in like early 2003, I think that was the bottom of the market before we went into Iraq, and then things started to go up. You could have bought like companies like Amazon. I'm trying to think of all the ones. Like I remember somebody coming to me and saying, "Oh, buy Amazon," and I was like, "Okay," and it was like pennies on the dollar compared to now. Like all these great companies, Apple. Like if you look back at the prices of some of these stocks back then, you would just shake your head in shame that you didn't go all in, right? Because we have history as our guide. However, at the time, and I bring this up to bring perspective to this, because we all live in the present, right? That's the only way to live. We live in the present. But our perspective is on recency bias. It's what happened most recently. So you look at last year and be like, oh my God, the stock market's terrible. You look back the year before and be like, stock market's great. Oh, we're all going to make plenty of money. We're all going to roll around in money naked when we're retired because we're going to have so much of it. And sorry about that visual. But, the point is, if you look at the time period you're in, your lens on the world is shaded by the perspective of the most recent. That's recency bias, right? The most recent gives you the most perspective. And that doesn't mean it's correct. It just means that that's how you see the world. So if you looked at the world in 2007, you're probably like, this is great. Like, you're going to make money. I remember having conversations with people all through 2008 who were like, it's fine. It's just a blip in the radar. Real estate always goes up. And then we had that implosion. Then people were, jumping out their first floor windows, screaming like, oh my God, the sky is falling. And, the perspective changed rapidly. And I think I bring these examples up because it's important to understand that we all do it. I'm not doing it to make fun of people. I'm doing it because you need to understand how your brain's going to work. Here's an example. I had one client who we were in cash for all 2008, and she was in cash, right? So she didn't lose any money. It was safe. And I get a call in October after the market had pretty much crashed. She calls me. She's like, "Oh my God, we're losing lots of money. What should we do?" And I was like, "What do you mean losing money? From where?" And she's like, "Aren't we down a lot because of the markets?" I was like, "No, you've been in cash. You didn't lose anything. You're safe." She's like, "Oh, really? Oh, wow. Okay, that's great. How much is my cash making me?" Now, I bring that up, and I just she was shaking my head. She went from extreme fear to greed, all in the sense of like a few seconds. Now, I bring this up as an example, and I always use this as an example because it's very common. Not only did she change her emotions rapidly, she went from like, "Oh God, thank God I'm safe. How much money can I make?" Now, if any of you were around back then, you might remember that was a time where you didn't know if your cash was going to be safe. Putting cash under the mattress was the safest thing you could do because you didn't know if any of the banks you were using were going to fail. And even though you were FDIC insured, you didn't know how long it would take for you to get your cash back, which I'm going to point out that's actually a big secret here. FDIC insurance is safe because they quote unquote guarantee you that you get your cash back under $250,000. The caveat to that is, oh yeah, you'll get your cash back, but what if it takes them 10 years to give it back? They don't say they're going to give it back instantly. And for those of you who lived through 2008, you know that even if you were in one of those banks, yeah, you probably get your cash back, but it might have been a year, 2 years. I mean, it depends on the bank and what happened. But the point being is understanding the perspective is important. So if you remember how it felt, right? Try to go back, put yourself in the shoes of who you were at that moment. How did you feel? It's really easy to say, well, in March 6th or 7th, I forget what day it was, of 2009, that was the bottom. It was really easy to say, oh, that was easy. We could have just gone all in. There was a time, 9 months after that, we were still, wringing our hands saying, is another bank going to fail? Like it didn't, just because it bottomed didn't mean that the fear was gone. And we weren't in the position where we were worried about that, but it was at a base level like, oh my God, what's the next bank that's going to fail? Like just because the market's going up doesn't mean that the failure stopped. It just meant that the market was going up. So I think the takeaway is to understand your own perspective on the markets. How are you looking at it now versus how are you looking at it later? If you're sitting in cash, you might feel good. And then you're going to look around saying, wow, look at all these deals because the market's down 20%. Yeah, those aren't deals. A deal is when the market's down 60%. A deal is when real estate is much lower than it is today. We're going to show you a chart in a minute. We pulled from some other people, which I'll share in the show notes. But effectively, if you look at what's happened, real estate, the cost of real estate has gone up. It's not doubled. At one point, I think around July, I think it doubled, but now it's down because it was 7.25%. Now it's 6.25%, I think, for mortgage rates. But that came up from 2.5%. So your affordability of what you can afford has gone through the roof. You can't afford what you could afford before. So maybe you can afford 40% less than you could before. And granted, that will narrow over time as interest rates, if they continue to drop and as real estate prices continue to drop, there will find an equilibrium. And what I'm going to share is going to share some of the predictions of the housing market that some people have speculated. But the point is right now it's really expensive to buy real estate. You want to be a seller, not a buyer. But having the perspective of just because real estate's gone down 10% doesn't mean it's a good deal. Like, how are you valuing a good deal? Just by the fact that a price has dropped does not make it a good deal. People do this with stocks. Oh, the stock's down like 20%. It's a good deal. How do you know it's a good deal? What are you looking at? What are your measurements? Are you looking at revenue? You're looking at profitability? You're looking at PE? Like, how are you looking at it? And most people give you this blank stare in the face. Like, what are you talking about? It's down. It's down 20%. It must be a good bargain. And the same mentality is an overlay when it comes to things like price. Well, price is meaningless versus market cap, right? Like if you look at the market cap, that actually makes sense. It's the number of shares times the price. If you're just looking at price, I mean, there were plenty of people in the 90s who said, oh, if a stock splits, now it's cheaper. Now I can afford more. No, it didn't do anything. It's like taking a loaf of bread and cutting it in half and saying, now you have 2 loaves of bread. No, you have the same loaf of bread. You just cut it in half. That's basically what a stock split is taking a loaf of bread and cutting it in half and assuming you have twice as much. You don't. And the same thing happens here. Like, you need to understand, and this is, if there's one takeaway I would say that you should take away from this, and there's tons you should take away from this session this week. The one takeaway is get really good at analyzing assets, stocks, real estate, whatever your interests are. Get really good at analyzing the value of it. And the value is subjective, right? You could look at different measures and say, oh, it's worth this or it's worth this. You're always going to have a debate about what it's worth. But generally speaking, you can find relatively where a good value is. 1980, 1981, those are the best values that we had seen in the last, I don't know, 70 years. The best values. That's when Warren Buffett bought a lot of his great stuff. The best value was then. Were there other good values? Yes, but not that good. And you could say, well, in 74, the market was actually lower than it was in 80, 81. Yes, it was. Nominally, the price was lower, but the value was better in 80 and 81. Why? Well, for many reasons, because the companies kept growing through the 70s, but the price never really appreciated. So technically, the companies were better off in 10 years, but the price was not. So the value actually increased in terms of what it's worth, but the price didn't, which means it was a better value. You got more for your money. So the point I'm trying to make is what we're trying to illustrate here is understand how to evaluate or value an asset. Warren Buffett's a good place to start. I'm not saying go become Warren Buffett, but it's a good place to start. He has a lot of rules, a lot of lessons that you could take away. Read up on people like Peter Lynch. Read up on all the good value investors out there. So there's some great ones on LinkedIn. Those of you who follow me on LinkedIn, I usually kind of like a lot of the people that I like in terms of their content. They're great stuff. Just find good people you can learn from. You're going to find the next 10, 20 years, the value is probably going to outperform growth. And you're going to be shocked in 5 years and be like, oh, wish I'd saw that coming. Well, you did, because I told you. You just might not have taken the advice. So just understand how to value things, because if you understand how to value things, you will be able to find a great value. Otherwise, you're going to be kind of swinging at a piñata with a blindfold on. So,
well, Kirk, I want to just one last thing, and I'll keep it quick on this. The other thing is because you talked about recency bias. Keep in mind where you're getting a lot of your information these days on what to do and how to go about it. I'm on social media. It's amazing the number of people that are out there giving financial advice, and these are younger. I mean, a lot of times these people are in their early 30s. Look what I did in my 20s. They've never lived through anything like we might be going through. So all of the information, again, they know what they know, and look how much money I made and what I did and why I'm, financially independent, retire early by my mid 30s. Yeah, well, if I take that math into consideration, a lot of them are like, if I go back 3 to 5 years ago, I was 100,000 in debt, and now look at me. Well, guess what? Congratulations. I mean, if anything you're going to take away from that, most of them, what they did right is they got efficient with their cash flows. They managed what they spent, they saved well. But when it comes to where to put your money, because there's so much of this advice out there on this is the best ETF, just throw your money in the S&P 500 index fund and throw your money in an international index fund and do that. None of these people, or just buy real estate, none of them lived through our last financial crisis. We have not had any major financial economic downturn in 15, 16 years. And that's before many of them graduated college, or if they ever went to college, or high school. So just remember, they don't really know. They're just telling you what they think from their recency bias. They haven't lived through this. And a lot of what they're telling you may be very wrong once you go into what could happen.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. Mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room. So I wanted to put up this chart, which you can see in the show notes for those of you who are not following on YouTube or LinkedIn. So I've been kind of trolling around looking for data and looking for good charts and looking for people who are kind of ahead of the curve like we've been. And I've noticed a few things. And so what's fascinating to me is there is some good data. And like I said, I'll share them. But some of the people are showing the overvaluation. So if you look at the price declines of last year, like what are the worst markets? Doug, what do you think the worst markets were last year for price declines?
You mean what areas of the country?
Yeah, what parts of the country? Let's take a guess.
Well, I mean, most people would think that, possibly Las Vegas, maybe California. Am I correct on that?
You're correct in California.
Okay. California, maybe New York, because I know there was a lot of shutdown during COVID and real estate there. Possibly, I'm thinking of places that are very expensive to begin with. Maybe New England, would come to mind. What are you thinking, Kirk?
Well, you wouldn't be shocked. You wouldn't be shocked to find out that 7 out of 10 of the top metro areas in price declines are in California.
Not shocked at all.
Yep. And after that, it's Austin, Texas, actually is 3rd. Seattle, Washington is 5th, and Boise, Idaho is 8th. Everything else is pretty much all the major cities in California. Oddly enough, San Francisco is not there. It looks like that is just off, just lower, but it's basically California is a disaster. And we could all speculate in the reasons. I think we probably know a lot of them. Just poor governance and high taxes, and just it's pretty much a flaming dumpster fire out there. To put it succinctly, except for the weather. The weather's nice, so that's great.
Well, being here in Minnesota, Kirk, and looking at this map doesn't make me feel warm and fuzzy about the Twin Cities either. And of course, we don't have the weather, so we've talked a lot about about the things that people love around here, and taxes and whether or not 2 of those things. So, so it's definitely I'm interested in those blue areas. I actually grew up in Columbus, Ohio, and I was just talking to someone the other day. Just like what happened in Dallas, there's some major companies that are moving in. I believe Intel is moving into Columbus with a tremendous number of new jobs. And, some of these corporate relocations, which, by the way, coming out of California, just like Toyota North America moved to Dallas out of California, they are bringing tremendous real estate appreciation with them because of the housing demand with the employee bases. But it's funny how so many of them are moving out of California. And so that doesn't surprise me to see it drop like that.
Yeah. So this chart is obviously a prediction, which shows how they predict the change of net home sales will affect 2023. So obviously it's predicting the future, which of course is totally useless. because none of us can do that predictably and effectively. However, I think as a trend, I think this is correct. So if you look at trends, then it would basically say that things like Las Vegas, Phoenix, Nashville, Tampa, Boise, Salt Lake, might have drops in the neighborhood of 20%. I mean, that's tough, right? A 20% drop from here. And I think one thing that we've seen in the last year is we had this, I guess, this illusion by homeowners or investors that we would just kind of bounce back in price and it would go to all-time highs and they could just hold through this. And so people weren't willing to lower their price, right? If I was looking to buy a home in July, it would have cost me twice as much as it did a year prior. So I would have been able to buy half the home. So my price for that same home would be 50% lower, right? And the homeowner's like, he's selling it for $1 million and he's like, whatever, I'm not going to sell it to you for $500,000. That would be silly. And the buyer, myself, is saying, yeah, but I wanted to buy the home before, but now I can afford half and everyone else is the same. So shouldn't you lower it? And they're just saying, no, I'm not going to lower it. And so they have this disillusionment of the price. And this is actually something that we just have like a smorgasbord of lessons here today, Doug, for our listeners. Here's another lesson. I had a client in 2007, 2008, and they were moving. They were living in a part of the country and they were moving. And so when you move, you have to sell your house and buy another one. And so what ended up happening was they got another job and they moved to a different state and they held out for an extra $10,000. They wanted to sell their house and they said, you know what? I'm not getting my price. And we talked through it. I said, what's your price? And I forget what it was. Let's say it was $500,000. And somebody wanted to pay $490,000. I was like, honestly, take it, man. It's $10,000. Like the market's tough. Things are getting rough. Like, I don't know how low it's going to go. I said, take it. I said, what if it goes down another 50 or 60? And they're like, yeah, that won't happen because real estate's resilient. What happened? And I'm going to like 400 or I think it was 350 or some crazy number. It went down a lot. It took them like 10 years to sell the darn thing. So the point is that's great if you want to try to squeak out an extra nickel, but think about the time value of money. If you take that, let's use a good example. Let's say, it's $1 million property and I offer 900 and and knowing these trends, let's say it's going to go to 600. I'll just say, great, I'll take the 900, I'll sit on my cash, I'll wait, and I'll buy something else cheaper, and I'll make my money on the other end. Those of you who listen to the show a lot know that I sold all my real estate last year. I was out. I got a good price, and I was done. And I'm happy to sit on the cash, and I'm happy to wait another few years till real estate finds an equilibrium. But I live in a part of the country, and unfortunately, Doug is in a different part of the country. But my part of the country, it's very interesting because we have people leaving. We don't have a lot of homes being built. So it won't get hit as much. And Boston is the most economically diverse city in the country. So even in 2008, I think it went down like 5 or 7% when everything else is like down 50 or 70. We're down like 5 or 7. It's something minuscule. But that's in large part because of the demographics of the city, which don't play out in any other city. And which kind of makes me feel special, of course. But besides that, you have to look at the dynamics of what's going on. You have this big boom in areas like Texas and Tennessee, Salt Lake, and Colorado, and you've got all these places where people are moving, and now they're realizing maybe I don't want to live there. Maybe it's not such a good place to live. And so, this happened in 2008. It's happening now, but it happened so slowly that the market is highly disconnected between price and affordability. So I think this year you're going to see a lot more people selling. You've got, I can't remember if we said this earlier in the show, but KB Homes, and you really want to screw yourself up. KB Homes had a 68% contract cancellation rate. This means 68% of the people who signed up to buy a home at KB Homes walked away from the deal. This was higher than 2008. This was a higher rate of cancellation in 2008. So understand the gravity of what's going on in the real estate market. You're not seeing this on a daily basis. Most people aren't. If you're not out looking for a home or selling your home, you have no idea what's going on because you're disconnected. It's like saying, how much does college cost, Doug? Well, I don't know. I don't have a kid going to college. It's probably really expensive. And when I get there, I'm probably going to, faint at the price of college, but that's a wholly different story. The point is that regardless of whether you're buying or selling real estate, you need to understand how it's operating, because this is literally like a mirror of what's happening in our economy. Economy works the same way as real estate because it's worked on leverage. People borrow money, it's more expensive.
Excuse me, Kirk.
Yeah, no worries, Doug. Get it out. Better out than in, right? So, just understand how important real estate is as an example. And yes, it's important if it affects you, but if it doesn't, it's an example of what's going to go on. So looking at this chart, I mean, it's claiming there's going to be a crash, and I guess maybe 20% drop in real estate would be a crash. But I'm not claiming there's a crash. I just think as a trend, you can look at this and say, all right, here are the areas that are problematic. Now, granted, I live in one of these areas, but I know what to expect, right? And Florida is going to have a tough time. California is going to have a tough time. Arizona, some of these areas, Las Vegas. There's some areas that, if you're looking to buy right now, you should be very careful. And, I had this conversation with a client yesterday, and he said, "Oh, I want to buy this property." And I said, honestly, why don't you just wait? I said, what's the rush? You're not going to get a good deal on it. You get a better deal later. What's the rush, right? And, if it's a trophy property, do whatever you want to do if you got that kind of money. But if you're really interested in saving money and doing the right thing, the best thing to do is just wait until the valuations find an equilibrium with the affordability. At least then you can justify the purchase. Personally, I think things are going to go a lot lower. It's going to take some time. The real estate market is going to be a mess. There's going to be plenty of inventory. People aren't buying. You're going to find great bargains. So if you are patient, you are going to find great deals over the next few years. The problem is no one is patient. People can't wait. They feel like, I'm sitting on cash. I need to do something. It's like sitting in the line at the grocery store and pulling out your phone because you can't just sit and do nothing. You can't just look around and enjoy like the moment. You have to be on your phone doing something. We all do this. There's the same thing with cash. People feel like it needs to do something. No, it is doing something. It's not dropping 20 or 40%. That is doing something. Just tweaking your perspective is what we're trying to teach on this show. We're trying to teach you how to look at things differently, how to tweak your perspective so you can look at things in a different way that is advantageous to your wealth. So I know we're kind of running close on time here, but Doug, final thoughts from you, and where can people find you?
Yeah, I think patience is really key. I mean, I kind of started this conversation like that. People aren't patient about where their money is in real estate. They think they're patient until all of a sudden something unexpected happens. And then their patience goes from infinite to zero very, very quickly when they don't have options. They don't have flexibility. And unfortunately, too many people financially do not create a plan that prepares for the certainty of uncertainty. And they expect everything's going to be okay. And then it isn't. And then they don't have the access to capital that they need at that time. Or they see an opportunity or that comes along, but they're not, again, those opportunities don't generally come with much advanced warning. And all of a sudden they don't have the flexibility to take advantage of that, to be able to buy low so that they can take advantage of opportunities like Warren Buffett does. I'm not telling you to sit on $1 billion in cash, but having flexibility is key. And unfortunately, too many people, as I said before, they just go about their business, put a bunch of money, max out their 401k, try to pay down their real estate as quickly as possible, giving all that money from their balance sheet to the bank's balance sheet, and all of that liquidity that they could have had, they've just transferred away. And then an opportunity comes along and they do not have that flexibility. So be patient. My wife has said to me for a year or 2 years, like, we need to get a new car. Guess what? I'm going to be patient on that. Imagine if I had bought a car last year during the peak of the pricing, I would have been a terrible time to buy a car, and I'd be suffering for that now. So I don't, my car needs some work. I've got, it's definitely needs some TLC, but you know what? I like not having that car payment, and I sure as heck not like not having an overpriced car right now when we're starting to see more and more information about what's going to really happen to the car market. So patience is key there. I just want to talk to you, if you want to find a little bit more information about us, I think a great place for you to take a look is, business owners, if you are listening to us right now and you are looking forward towards the future of kind of what could happen to you in your business. Maybe you're working too much. Maybe there's stress. Maybe the economic outlook of uncertainty. Listen, maybe you just don't like losing money that you might be losing unknowingly and unnecessarily, that might be hurting your ability to be flexible, or hurting the value of your business and your ability to have that money, that business maximize both the balance between your life and your money and your time. Check us out. Go to Automatic Business Method right now. If you go to Automatic Business Method, you can actually download really, really quickly. You can download our new document, our growth cheat sheet. Go get that for free, the ultimate 2023 growth cheat sheet, so that you can make sure that your business is positioned to handle whatever it may come at you, especially in uncertain times. So please go there, automaticbusinessmethod.com, to get more information, get that free report or that free cheat sheet.
Great. Well, Doug, appreciate you coming on the show. And just want to kind of leave everyone with a thought. So there's a thought from, I believe it's Howard Marks, who is a very well-known institutional investor. If you don't know him, look him up. He's brilliant. And his newsletters that he sends out are brilliant as well. What he said was, whatever made you the easiest money during the last decade could be your worst idea today. So think about that. We've been talking about this in the show for the last year. So if you don't listen to me, here's a guy who knows a lot more than me, and he's saying the same thing. Whatever made you the easiest money, which is virtually everything, right? Which is real estate, stocks, whatever. It made you easy money, or meme stocks, tech stocks, all that. It could be your worst idea today. Now, he's saying that for a reason, right? And so if you don't listen to us, please listen to him. Some of the smartest people on Wall Street are coming out and actually saying some of the things that we're saying on the show, which must mean something. I'm just trying to, peg your level of interest in the show. But the point being is, all of these things are really important to understand. So we really want to educate all the listeners. We just want to make sure that everybody is safe during this time. And I want to get this message out to as many people as possible. We've been spreading the word. Last year, we were early, not early in the sense that we were early, but earlier than everybody else. And we're going to keep saying this message. And I kind of feel like we're a little late now and we're beating the dead horse because everyone's talking like this. But believe me, some of the stuff that you're going to hear in the show over the next year is also going to be ahead of the curve. So stay tuned and listen up. But hopefully everyone enjoys their week. And we'll certainly be on next week with another episode to help keep you in tune with the market. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name is Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.